Good morning, everyone, and welcome to this early session on impact investing. You guys are the brave ones to be out at this early hour at Milken. Thanks for joining us. As I think many of you know, it's been a really exciting topic that's already seen some heat at the conference this week. In sort of honor of the conference and to mark some of the conversations we're going to have, I put out a piece in Forbes this week that boldly declared it's a new inning in impact investing. And I invite some of you to take a look at it. But the idea of that was really to reflect on some of the momentum and really strong traction we've seen in the space. But because we're just not talking to the audience with us this morning, we also have many who will join us online through the stream and through the recorded video that comes. You know, let's level set. What are we really going to be talking about this morning? Well, impact investing at its simplest is just new ways to solve old problems. When we look at the dogging challenges of the world, what we see is that we've had a lot of good intention, a lot of smart people, and a lot of capital going after solutions. But too often, we haven't invited businesses and specifically entrepreneurs to the table. So one of the things you're going to hear from our panelists this morning, and some of the things we want to talk about, is what does this new world look like where we have a new class of entrepreneurs coming out who don't just want to build companies for profit, they want to address a social challenge and bring a strong social benefit. And a new class of investors emerging across sectors of all kinds who say, I want more than just a financial return from the money I invest. So that's going to be some of the conversation we're going to have this morning. Just to level set on a couple of things, when we talk about impact investing and we talk about companies specifically, we say three things have to be present. They have to have clear intention. They have to have a commitment to measurement of the impact they're trying to have. And lastly, they have to be very transparent and tell the world and all of their stakeholders, including their investors, how they're doing against that intention and impact along the way. So that's a rough description of how we look at impact investing. I've been really, really excited this morning because we had a conversation amongst us and we were saying, too bad that wasn't the panel. We got pretty excited this morning talking about this subject together before we came on stage. And what we're going to try and do this morning is really try to have the panel be a little more interactive. I do have some questions for these folks, but I've really invited them. They're all great leaders in the space, and I've invited them into the conversation at any point. So the rules are we get to interrupt one another, we get to disagree, we might even want to say some controversial things where sort of the jury is out on how real is this, etc. But let's get started. So let me start by introducing the panel quickly, and we're not going to go into long introductions. They'll each speak at length, really, about the work that they do as part of the Q&A that we go through. So starting all the way to my right, to your left, is Tom Hyland. Tom is co-founder and partner of Aspada Investment Advisors. It's an early-stage venture capital fund in India, anchored by the Soros Economic Development Fund. And we're going to hear from Tom about his work, important work in India. Kimbal Musk is to my immediate right. He's co-founder of The Kitchen, a family of restaurants focused on sustainability. And he's getting ready to do some pretty exciting things in Memphis that he's going to talk to us about. Kimbal is also serving on the board of Tesla and Chipotle, so we may have some things to say from that perspective as well. I think the woman to my left needs no introduction, certainly to this audience. Jacqueline Novogratz is founder and CEO of Acumen. And Acumen raises charitable donations to invest in companies and leaders and ideas that are tackling world poverty. And she's been at it a long time, and many of us have a great deal of respect for her, a true pioneer in this space. Welcome, Jacqueline.
Thank you, Jean.
Dimple Sahni is Senior Director for Impact Investing of Anthos Asset Management, a family office based in the Netherlands, doing all kinds of really cool stuff, including some new research that hopefully will add to sort of the base of data that many investors are waiting for and looking for before they jump in. And we're going to ask Dimple to share that. So welcome, Dimple. And last but certainly not least, an old friend, Gary White is CEO and co-founder of Water.org, a nonprofit organization dedicated to empowering people in the developing world to gain access to safe water and sanitation. And Gary and his work in water has been well known for a long time. Many of us have had the privilege of working with him. And he's going to talk a little bit about a hybrid model he's bringing forward. So super excited to be here. I think I can convey that on behalf of the whole panel. And what we're going to do is just kind of have a conversation amongst us for about 40 minutes. And then we hope we'll have a conversation with you. We hope you'll bring your questions or even your ideas that you might have for some of us. And we'll go to Q&A after we have this discussion. So Tom, let's start with you. You're doing some really interesting things in India. And you know, one of the questions that's come out from some of the other gatherings we've had here at the conference, and I hear it at every impact investing table I sit at, is, so what's the story with deal flow? Are there real deals, real investable deals out there? Are you seeing that in India? And sort of what's your take? And in the investor class that you've been able to sort of bring to the table, how do you see sort of the investor horizon for impact investing?
Sure. Thank you, Jean. So just a brief introduction. You know, we run a holding company called Aspada, which is a permanently backed vehicle from the Soros Economic Development Fund. And we invest not so much in sectors, but themes. And those themes are really around market linkage, access to markets, and access to small business finance. Specifically to the deal flow question, since we started investing around 7 years ago out of our first fund, we've seen about 1,500 deals. Now, we've invested in a total of 12, and there are numerous reasons for that, and you know, to some degree it follows a fairly typical venture capital funnel. But we cast a fairly wide net, and quite frankly, many of the deals that we've invested in might not be those that would be familiar to those that are investing in traditional social entrepreneurs, right? And what I mean by that is the entrepreneurs we backed generally have come with very significant domain expertise in India in their respective fields. We're invested in a chain of hospitals in South India that's run by the former COO of Apollo, which is India's largest hospital chain. We're invested in a company that's one of the largest players in the processed potato supply chain. Works with 15,000 farmers across India supplying seeds and inputs and aggregating. You know, this is someone that ran Frito-Lay's contract farming business. So we think that these businesses, by the nature of what they do, have outsized impact. But when they come to us, they're not identified necessarily as impact deals or social enterprises. And for us, we view the decision as to whether or not to invest or whether or not this business meets the criteria as ours to make, not necessarily for the entrepreneur to convince us of, right? If it checks our boxes, we will put money to work. And we have found, given that India is an extraordinarily difficult execution market, that we have tended to back teams with very significant operating expertise. And quite frankly, if I look across our portfolio, I'd be surprised if any of them had ever heard the word social entrepreneur. And I don't think they would identify themselves, even though you know, the businesses that they're building you know, are having significant impacts on the ground.
Great, great. So Dimple, I want to switch to you. You know, I referenced in your introduction some of the work that you're doing at Wharton to take a look at returns and what the experiences have been in this space. Can you talk a little bit about that and let us know sort of your view on data more broadly and what took you to that work?
Yeah, absolutely. So very briefly, I work with Anthos. It's a single family office based in the Netherlands. And this family had been doing philanthropy for hundreds of years. It's an old established European family. And individual family members had been doing impact investing on their own. And about a year ago, they decided to pool their efforts and pool their capital and really use the family office as a platform to do impact investing. And we were given two mandates by the family. One is to build a really bold catalytic portfolio using a number of different instruments, including looking at holding companies like Tom's. And the second was to really build the field. It's within that second mandate that we thought, okay, what are the current bottlenecks in the space? And an obvious one is exits and liquidity, and demystifying it for the space, because we thought that was a big deterrent on why others weren't entering. So my colleague Lisa Hall, who most of you know from Calvert, she is helping lead the efforts as well. We both went to Wharton Business School, and so we decided to call upon our alma mater and their social impact department to conduct research on the industry, figuring a school would be a very unbiased entity to do so. So I'm going to share just a couple of slides with you on some of the findings, but broadly speaking, they polled about 48 funds, and the survey is still open, so I'm hoping if there are some fund managers and LPs in the audience that you'll contribute to the survey, because like with any portfolio, you're only as good as the data and the underlying investments. So 48 funds committed to the survey, representing about 450 portfolio companies. Can we pull up slide 9, please? And I think one of the biggest stereotypes within impact investing is that social impact means you're going to take a haircut on returns. And what the evidence showed, according to our researchers, is actually all the funds who called themselves market-based funds, the exits in which they had a mission-aligned exit, where the social mission impact was documented and held through, actually performed much better than the ones that didn't have a mission-aligned exit. And if you can go to slide 11, please. I want to talk about IRRs. So, everybody holds investments based on geographies at different valuations. In Brazil, for example, you have to hold everything at cost unless you have a realized exit, which isn't completely fair. So we took an analysis, or rather Wharton took an analysis and said, if you held everything at fair market value, what would the IRR be? If you held some of the things at cost as you're required to do, what would that be? And then if you had a blended approach, what would that be? And the column I want to point you to is the third one, which has 12.49%. This is where we took a realistic view of what the fair market value of some of these portfolios are, and where we held some things at cost in year one. And if you look at that IRR, and for investing across the globe, including emerging markets, it's commensurate with a market-based return. And the exit slide, which I showed earlier, showed a 41% IRR for funds and companies that exited with the social mission intact. So we're hoping that this data actually catalyzes more people to get into the space, to encourage exits and liquidity events that are aligned with their mission, to show that you actually don't have to take a haircut on returns.
Boy, I really appreciate the work that you're doing. I think that investors do need to see data to feel comfortable. For those sitting on the sidelines who want to jump in, building out the ecosystem, and data is a part of that to tell us what has really happened in this space. We've seen a couple of other things. There's a foundation in San Francisco, the Kleisner Foundation, in which they're 100% impact invested through their corpus, and they're very transparent about their returns by asset class. And what they've made clear is that they are at or above benchmarks in 4 of their asset classes. And then, of course, just recently we saw Etsy, a B Corp, go public. So there, the transparency around sort of how is the market responding to this company with an impact focus, we'll all be able to watch and see. And so I think we see a growing body of data, growing transparency around those that are engaged in investments in this space. And I think it'll be fun to watch, but it'll also, I think, really broaden the pie somewhat in terms of investors coming in. So Gary, I want to turn to you. You've been deeply focused in water for a long time. We've worked together, the Case Foundation, with you for a number of years. But recently, you as an NGO decided that you're going to stand up a fund. Can you talk a little bit about why are you turning to a hybrid solution? What gap areas are you trying to really, meet by that kind of action? And what do you see?
Sure, thanks. And it's great to be here to have this type of panel, because a lot more dialogue needs to happen around impact investing like this in these settings. And I think one of the reasons why is to show the spectrum here. Before our session today, we were sitting around talking about the gray area.
Right.
And I think there is a lot of gray in here in terms of this risk-adjusted return. And what we're looking at is water and sanitation needs of some of the poorest in the world, people making as little as $1.25 a day. And it's really hard to connect a risk-adjusted return to them. But we think we can do much better than what's second best in the field right now, and that's a subsidy model that basically subsidizes 90 to 100% of the cost to serve the poor in terms of philanthropy and charity. And so what we see is the fact that we can help the poor tap into what we see as intrinsic power as customers and match social impact investing with them. And by that I mean the fact that the poor right now have these incredible coping costs.
in terms of getting water and sanitation. I was in Bangalore, India recently. I met a woman there who was paying 20 rupees every day to get water from these private water vendors, sometimes called the water mafia, and she was paying 20 rupees a day for her family members to go use the public toilet. 40 rupees a day, 1,200 rupees a month. Now that only comes out to about $18 over the month, but to her that's a small fortune. So what we helped her do was using capital from the social and the commercial capital markets, fund a loan portfolio through MFIs, microfinance institutions. She took out a loan for a toilet and a water connection. Her loan repayments for the next 2 years were going to be 1,200 rupees a month. Exactly the same amount that she was paying for these coping costs. And there's billions of people that need water and sanitation that are paying these coping costs. So what we see, the reason to start the fund was to, for the first time, connect social impact investing through an equity fund with a modest targeted return of 2% and a 7-year tie-up to women like her, and showing that you could connect that cycle back upstream to the impact investor. And so we've already piloted this for a number of years, and so far we've enabled over 500,000 loans benefiting 2.3 million people. And those loans at the household level, and 94% are to women, are repaid at 99%. So our equity fund will basically come into this, scale it up in order to make that happen in more countries around the world.
Yeah, so I think that's a really exciting example of innovation being brought to a challenge, and we sometimes refer to that as using all the arrows in your quiver. Do we need philanthropy? We absolutely need philanthropy. It plays an important role, as does the NGO sector. But sometimes we need a few more arrows in our quiver, like business, like financial tools, like bonds, like companies, to kind of fill out the space. And I think we're excited by what we're seeing there. What Gary talked about really, though, is when you think about impact investing, philanthropy is 100% loss of capital. Impact investing can be market rate return or beyond, and everything in between. And yesterday, a bunch of us got together in a roundtable conversation, and we had with us some students, students who were masters in finance, and they'd had a challenge competition around new innovative financial structures that could bring innovation. So I think this whole idea of what might we try, where can we go in this space that we haven't, is really something exciting to see. Jacqueline, I asked you if you'd kind of go last in comments, because if you want to bring us home in terms of what's been talked about, but you... Thank you, Kimbal. Thank you. Actually, we go to Kimbal. So, Kimbal, I asked you before. Too many panelists, what can I say? I asked you before.
She said she was going to shake it up.
Yeah, just by forgetting people. I asked you before if you would please talk a little bit about what you're doing in Memphis right now, but just more broadly. You know, I think you're doing some of the most innovative stuff, and particularly as a solution for our cities.
Yeah, I will talk about the stuff we're doing in cities, but I think the conversation is fascinating because I am an entrepreneur, I'm not a finance guy. And I have built companies that have been incredibly hard to build because there were no such thing as impact investors when we started Tesla.
Right.
Chipotle had to take money from McDonald's to grow its business, which is so far away from impact, it's unbelievable. And so what I've done over the past few years is I've decided about 5 years ago that I'm going to focus on food and only food, and get our communities thriving through connecting them to real food. And how I do it is up to the city, or up to the community, and so forth. And I went down the path of fundraising, as I would normally do, like in the Tesla days, and expecting nothing but pain, because people say they care about mission, they don't really care about mission. And when the shit hits the fan, then you really find out who doesn't care about mission. And so I really was very concerned about how to build this next project that I was going to embark on, because it wasn't really a business, wasn't yet a business. And I discovered that there's a nonprofit path where people will give you $1 and expect nothing in return. And it was kind of surprising. I'd never done a nonprofit before. And I was like, really? You can give me the money and that's it? And it really, I mean, to such a degree that we've now raised over the past 3 years about $10 million in working with kids in schools, building these outdoor classrooms, teaching these kids science using the growing of food. We're in 225 schools and growing rapidly. That's the nonprofit. Then you get a PRI, which I'm learning, is a way for a family office or a foundation to make a loan, and if the loan doesn't get paid back, they can convert it to philanthropy, which is a phenomenal piece of the tax code, and we're starting to do those. And then you get convertible debt, where an impact investor says, well, I really care about the impact. Impact first, absolutely. But I just kind of want my money back. But if it does go well, I would be open to converting it to equity. And I haven't done one of those yet, but that's starting to come up on the radar. And then the final one, which is the invest in the entity itself, that the for-profit entity that may or may not be a what do they call it, a unicorn nowadays, where it'd be $1 billion valuation within a few years. Those ones are also available, and so it's frankly, that last category is super high risk. So a lot of the family offices and foundations are not that interested in that category. They're what I found is more of the interest in the first two, the giving it away or the PRI, and then a little bit of interest in the convertible debt, and very small amount of interest in the high-risk approach. But regardless, it's just a number of vehicles. As an entrepreneur, I'm looking for the lowest cost of capital to build out what I can do, and also be as efficient as possible with that capital. The category of impact investing is fascinating from an entrepreneur's perspective, and I'm hopeful with sharing as much of this as possible, we'll get more entrepreneurs realizing they can be a social entrepreneur and actually make money for themselves, because by the way, they're working their ass off, so they should be rewarded for it, but do it in a way that there's multiple types of capital that they can bring in besides traditional venture capital that I've used in the past.
Yeah, I think that's really helpful. That was a great little flyover, and it's a darn good thing I did call on you. That was a really helpful flyover, really, of sort of just some of the unique ways people can bring capital. We've participated in all those ways as impact investors, and another way we've done it is through loan guarantees.
Yeah, totally.
Right?
Yeah, I've done those as well.
Right, and we're pleased to say that where we have done loan guarantees, the loan's never been called.
Yeah.
So for us, it's great. It sits on the books. It's a liability until they've basically made good on the loan. And so it's truly 100% return of capital to us. Whereas had we done it as a grant, it would have been 100% loss of that capital. So lots of exciting ways. And one of the reasons I was so happy to have Kimbal on the panel this morning is because you can already hear he brings the DNA of an entrepreneur, and everything he's done, he actually brings that entrepreneurial spirit I was talking about. And we were saying earlier, the gray that was referenced earlier, we sort of need hybrid people, hybrid teams, hybrid everything, because for too long, you've had, just the strictly financial focused folks over here and the all mission folks over here. And it's a beautiful thing in the world when this starts to happen. And so now, Jacqueline, will you please bring us home after
now that you got it even more
ever important Kimbal Musk.
Thanks. And Jean, thank you for being such a spokesperson for this emerging sector. As I was saying before, it's a big deal, because if there's a single line to say about this sector is that we really need a plea for nuance. And you're really doing a great job there. Because as you can hear, we're hearing from 2% to 40%, all under the rubric of impact. We're hearing about companies like Chipotle, and we're hearing about bringing water to people who make $1.25 a day. And so I think if we could step back and not get distracted by the overall rubric of impact investment, and we all want to call ourselves that, regardless of whether we consider making any investment in Africa that's not doing harm an impact investment, or solving a critical problem facing people who make $1, $2, $3 a day, then we really start to create a more nuanced and frankly segmented sector, which is where I think we all want to go and need to go. The great thing about the impact sector is that it's the most collaborative sector that I know of, in terms of people starting to recognize that we play at different levels. So Acumen would go early stage to the bottom of the pyramid, which requires grant capital to actually back your investments, or else, as Tom said, an impact investor is not going to want to put the impact investment in. As they grow, there's real opportunity then for one of the larger funds to come in and take these companies to the next level. A quick example, and then I think that what Dimple's talking about on the metric side becomes really important, and I'm hoping that it's not just for impact, but for all companies and all investors. But an example would be where Acumen has focused is in ambulances, where when we first looked at an entrepreneur who had this huge ambition to disrupt the Indian ambulance industry, which was a multi-billion-dollar, highly corrupt, very bloated industry that poor people would never get access to. Frankly, the middle class wasn't getting access to. We bought 30% of their company that had all of 9 ambulances for a city of Bombay, which is 20 million people. It felt somewhat quixotic, and yet the bet on the entrepreneur felt worth the risk of capital. Over the last 9 years, in addition to an impact investment, a lot of grant capital has had to go side by side, sometimes directly into the company, and sometimes through indirect mechanisms, primarily talent, because we don't talk enough about the subsidy of talent that needs to be injected to build this company.
How do you put a grant into a for-profit? Is it a for-profit or is it? Because I've been offered grants into our for-profit, and I don't know how to take them.
Happens all the time.
I can teach you to take it in a
Happens all the
minute.
time.
Say yes.
Really? That's fascinating.
Say yes.
See, there's a whole other mechanism.
In fact, if you look at many of the big success stories in impact for the BOP that are disrupting major industries, D-Light, for instance.
Right.
When D-Light first started to bring a solar torch to poor people, the cost of solar was $4 a watt, 2006. The poor didn't want to buy it. So you had to actually create a whole marketing strategy that the company didn't have equity capital to do. We assume build it and they will come, and we learned that that's a big fat lie when it comes to markets of the poor. There was no trust. They had seen poor quality since the early 90s, and we had no payment mechanism because people paid day by day for their kerosene. So a number of really smart philanthropists, not Acumen, came in with literally millions of dollars over the last 9 years, primarily on marketing. Then we could get them together with Dow, who brought in some of their best people to help them on supply chain. And we've now seen D-Light bring solar light affordably to people who make $1, $2 a day to 50 million people.
Does the philanthropy subsidize the cost of that for the for-profit? Because so we do restaurants, and we've been asked to go to poor areas of a community, and they've said, you know, the salad is $7 on your menu, which is a great salad, you know, good quality real food. But we need it to cost $4, so we'll subsidize the $3.
Yeah, we're seeing that all the time. We're seeing that. So in Detroit, for instance, where there are true sort of healthy food deserts, and this is true in a lot of urban places in the United States, the Kellogg Foundation came in and actually put up funding to bring whole foods in. On 2 impact startup boards I'm on, one of them is a company called BrainScope that provides a mobile solution to aid in diagnostic of TBI and concussion. Think about our soldiers, think about your kids on soccer fields. Using a mobile device, using leads on the head, you can actually determine if a brain injury has taken place. And concussion is an area where for too long in too many places, we've used the same protocol for 50 years, not taking advantage of technology. Why am I bringing that up? The military has put $28 million in grants into the company because they so want to see this solution on the battlefield. Another company I sit on, Snag Films, the Knight Foundation came in and underwrote digitizing content from documentaries that can change the hearts and minds of people around things that we care about. Grant into a for-profit organization. So we see lots of these models, and there are tax laws, there are clear things that enable that kind of hybrid approaches. I think that's how we're going to see things scale here.
And government.
And government.
Yeah, government.
That often you see people say, you know, I really love what you're doing because it's all the private sector. But if you really look at basic service delivery, which are, you know, frankly, wildly broken. There's a reason that over 2 billion people have very limited or no access to electricity. This is not a full private sector play, and certainly not yet. Same with emergency services. So the reason that this ambulance company went from 9 ambulances to now 1,400 ambulances of 6,000 people, and they're serving half of India, is because it went from a pure private sector model to a private-public partnership. That allowed it to scale. And then when you circle it back to this kind of investment capital being different for philanthropists and for impact investors, it's because we finally have tools to measure change. And we've been working with Grameen Foundation to do what we're calling lean data, where we can actually use cell phones to reach out to the users of these products, whether it's water, or in this case ambulances, to understand not only whether they value the quality of these products, but how poor are they? Because that matters. Are they female, et cetera? And what we found is that in this case of this ambulances, 76% of the people who use it make under $2 a day. 70% of the users are female, and essentially half the users are females that are using the ambulances to go to hospital to have babies, but most of them have their babies inside the hospital. So it's exposing the fact that we have so little primary health care, which we knew, across India. Major opportunity then for smarter capital, smarter nonprofits, smarter government, and smarter private sector to work together. And so at the end of the day, what I think impact investing as a rubric allows us to do is determine what problems we're trying to solve, have the courage to embrace the difficult and not stick on this, I want an easy solution, because we're talking about intractable problems that they're intractable for a reason, and yet see it as major opportunities if we can get clear about what kind of capital and what kind of interventions are needed. And this panel represents all the different ones.
Yeah.
Tom, I think, wants to say something.
Yeah, no.
Jump in, Tom. You guys just jump in.
No, and I think that this issue around the kind of capital is critical. We manage two funds. The first is known as SONG, S-O-N-G, and SONG is an acronym for our investors. It's Soros, which is Soros Economic Development, Omidyar Networking, Google. That fund has done quite well. I mean, we are much closer to the 40% IRR camp than we are 12. But one of the things we've seen, and a quick plug for Milken, is when we were between funds, we actually devoured a lot of research that was put out by this institute by Glenn Yago and Caitlin McLean around long-term permanent capital vehicles. And that very much influenced what we did in Aspada. And in fact, we actually operationalized a lot of what was put in those white papers from this institute. What we find is that in India, if you're talking about basic service delivery, building supply chains, building schools, building hospitals, you need to take a real full stack approach, right? I mean, that's something that's often used in technology. But you can't take for granted that you have service providers, that you have the kinds of things you would take for granted here in the West, right? Here, the roads are built. You have 24-hour power. You have a relatively high level of services that you can plug into. To build a vegetable supply chain in India that connects a farmer to an end market, you need to build it yourself from scratch. That takes time. That takes money. And it doesn't necessarily lend itself to a traditional VC cycle, right? So we have the ability, if there is a subsidy in our model, to stay invested in these businesses for the long haul.
I think that is exactly right. So if you can look at it from a longer time horizon, and you can say, okay, like in the case of food, with roads in farms, people talk about, let's figure out farming in Africa. Just give them roads, and they'll get there. There's plenty of farming. They just can't get around. And the roads is what gets the food around. But if you can skate to where the puck will be, and you believe the government will actually step in the case of food today in America, there is regulation that is starting to appear to protect honeybees from the pesticides. The amount of pesticides and herbicides we use in farming today, it's so bad. It's about 20 times more than we used 20 years ago before GMOs were implemented. Forgetting the positives and negatives of GMOs, they're basically just designed to enable more chemicals. The government will step in. And when the government steps in, assuming you make that bet, then there's incredible opportunity for an entrepreneur to participate in that upside, in the change. Back in 2008, President Bush put a $25 billion fund in place for alternative energy vehicles, and that was in the works from 2005. And all of our investors, as entrepreneurs, were going, please, please let that exist, you know. And you just never know, you never know, you never know, you never know. But you do have to have some faith. When that came through, you know, $6 billion to Ford, $5 billion to GM, all those guys. At Tesla, we got a $500 million loan at 3%. All of a sudden, we were a real company.
Right. That's a really important example. All right, Dimple and Gary, what say you? I mean, we're talking about a couple things here. We're talking about, you know, we do think there are places where when you're dealing with intractable problems that Jacqueline talks about that have been chased forever by a lot of smart people, do we need investor capital to be more patient in some cases in this space? And what are you guys seeing out there?
So for us at Anthos, when we think about our portfolio construction, we're taking all of what they said, yes, yes, and yes. We are going to construct a portfolio that has about 1/3 in fixed income or debt type products. That's junior, senior, mezzanine, convertible. We're going to have about 1/3 of the portfolio in venture and private equity and those type of structures and returns. And then we're planning to have 1/3 of our portfolio, which is permanent capital. Holding companies, open-ended funds, evergreen funds. And we're actually hosting a convening on a holding company structure because we really want to push the boundaries on what Aspada has learned and what others are trying to do and where this model could evolve. Because I think family offices in particular, they have the ability to truly be patient capital. So our family is less concerned about the IRR and when they exit, but they want to have long-term capital appreciation. They want to have public-private partnership models which just take a longer time to come to fruition. Within that, if there are liquidity mechanisms, redemption mechanisms that people can have, we all know everybody has different liquidity needs.
Right.
Even Gary's vehicle, the Water Fund, that's something that we're looking at as well. So we're trying to play up and down the capital structure. And Tom made a point yesterday in Jean's session about how there aren't enough growth equity investors in this. And Jacqueline and her team are coming in at the front end of the capital frontier. We're playing in the middle. We would actually like to be the exit for a lot of people. So if there are funds that may not live to see Fund 2, Fund 3s, have portfolios, have companies, that's something that our family is exploring and creating a secondary market around these investments. So I think there's a lot of room for growth, but there's a lot of great lessons learned.
Yeah, and I do think, just in fairness, we've been, through my husband's investment company, Revolution, you know, providing some growth investment in Revolution Foods, for instance, a very exciting company, if you don't know about it, providing what we call kid-friendly, chef-inspired healthy meals in schools. And they deliver over 1 million meals a week, and they're a $100 million business, and we invested $30 million. So we're starting to see, and the Revolution is not an impact investing fund, okay? They competed against everybody else in their space, and they won. So we are starting to see some growth level investments really at scale. We've got companies sitting out there like Warby Parker, for instance, you know, and it'll be interesting to see where they go for a liquidity event or an exit. But Gary, how do you look at this whole issue of exits? Another thing that comes up in a lot of conversations.
Well, I think, first of all, just in listening to folks along the panel here, and someone who's been focusing on water and sanitation at the base of the pyramid since, you know, the early 90s, to even have this kind of conversation about social impact investing, which didn't even exist. I think we also need to acknowledge what's happening in certain foundation investments to actually enable all of this conversation to happen, and that is really the investment in social entrepreneurship itself. And I think like the Skoll Foundation and the Schwab Foundation have done a tremendous job at getting people into thinking entrepreneurially in the nonprofit space so that we can go out and experiment and try and innovate. And I think that's where the philanthropic capital comes in early stage to invest in people. Then I think it also comes into play from a philanthropic perspective to help get these markets ready. And there's no market that's been harder to get ready than people making $1.25 a day getting water and sanitation. And so we've had great philanthropic support from the PepsiCo Foundation, IKEA Foundation, Caterpillar Foundation, MasterCard. They've all come in with philanthropic capital because they could see that there was a light at the end of the tunnel in terms of having a more market-based approach. So I think following along that spectrum all the way to the point where we can go kind of from the philosophic and the academic to the real practical to now have this fund that we're talking about. And regardless of the structure, how it works, and there's all kinds of ways to make this happen, you can kind of get confused by that even when you're in the middle of it. But the bottom line is, for us, $1 million invested in the fund targets about 10,000 people to get water over that 7-year period. So you have a $1 million investment. The target is a 2% annual dividend, and at the end of the 7 years, you get your bullet payment back. But in the meantime, 10,000 people have gotten water. I think we need to distill this down to that.
Your bigger play in some ways, your bigger play is once you, over the 7-year period, or hopefully earlier, prove the viability of water credit, then the financial system may actually start to step in and build it. Because both in energy and in water, the capital markets and the direct consumer financing models are broken. As much as people say they want to work in this area and why not microfinance, it's not happening. And so part of what you're doing is, yes, having direct impact on 50,000 people through these 10,000 families. But your bigger is, in doing that, you are proving this viability. And that is critical as a role of impact investing.
Absolutely. How do you graduate from this 2% return to a market return? That needs to happen, but you've got to have these
Or maybe you don't graduate
steps.
to a market return,
maybe you don't.
but you look at a tax, that it becomes so important for the government in a country like India to get water to the 600 million people who don't have adequate access.
Well,
that they then look at a tax structure that allows this to happen.
And that was the point. You made a great point too about the public sector having a role in this, and I think that's exactly what we're trying to do. We're not going and developing parallel systems to the public utilities. We're helping people and enabling them to get connected to the public utilities so that public mandate can be lived out on the part of government and utilities. A lot of times people, all they lack is that $200 loan that they have to pay for the connection fee, for the right to connect to the utility. So we're really leveraging the public investment that goes into the utility and encouraging the utilities to expand that infrastructure into poor neighborhoods. Why would they do that? Because now there's paying customers that are there willing to connect, pay the connection fee, and pay the water tariffs. That's where you get tremendous leverage by leveraging these public investments.
Yeah. So for those of you in the audience, we'd love for you to join in this conversation. If you have questions, there's a microphone. If you have a question, put up your hand. They'll bring a microphone. Why don't we start here in the front? Please wait till you have the microphone so that the audience watching can hear the question as well. It's down here.
Hi, great discussion. Frank Altman with Community Reinvestment Fund. We are a national nonprofit in the United States that finances job-creating small business in low-income communities. We finance women and minority entrepreneurs throughout the country. We have loans in about 800 communities in 47 states. My question is, when is debt an impact investment? And how do the people on the panel look at job creation as opposed to what most of the discussion is spent on the business or on the customer, but where does job creation fit into the impact investing
So I'm going to take this one because this is going to be a good chance to talk about Memphis. So debt is actually, I think, the best tool for impact investing. And the reason why is because you can really tie debt to very specific social outcomes. But when you go into equity, you go into the overall company, and the company has many, many directions. You need to give it as much flexibility as possible. So I have a restaurant group called The Kitchen, which builds restaurants and helps build up the farm supply, creates jobs, like you describe, in much better jobs in the traditional restaurant business. And we were drawn to Memphis. They asked us to consider doing our nonprofit, obviously for schools, and also to do the restaurants. I offered them an equity investment. They said, we don't really want to own restaurants. We just want you to come to Memphis. And so we created a debt instrument which has obviously it's a low interest rate, but it's a rate of return of 3% or something like that. And critically though is the actual number of dollars we're going to be buying from local farms, the number of jobs we would create, and then enshrining the type of jobs, because in the restaurant business you can really go to a dark place, and so you don't want to allow that. And they trusted us, but we actually insisted on enshrining it because we wanted to use it as an example for other places. And it's very exciting. And that debt instrument is what will hold us on a quarterly basis to our social metrics and goals. And whereas it was equity, it would be very hard, I think, to do that.
Yeah, that's a good point. Please keep answering, but I just want to send the microphone.
Well, I just want to say that you can structure it pretty simply so equity can be something other than just investing in the organization. So the fund that we have, it goes through a separate LLC, which isn't hard to set up. and that is not on the water.org balance sheet, and investors aren't investing in us from an equity position in water.org. They're investing in this carve-out of an LLC that's going to provide debt financing to these loan portfolios. So it can go both ways.
Can I just say something on the debt piece? And I know your question is more specific to the U.S., but at least in India, and I think Jacqueline will agree with me, debt is the biggest piece by far. The debt markets in India are largely closed to foreign direct investment.
Can't do that.
And so what you end up having is this very, very selective group of impact investors looking to make equity investments in companies that otherwise might be debt candidates. And a lot of companies, some of ours included, use equity for working capital. It's an enormous challenge, and I think truly some of the most exciting conversations happening on behalf of foundations and others around how do we structure creative and interesting debt-like instruments to put into these markets, whether it's India or other markets.
Yeah, great point, Tom. Let's go to the next question.
Can I just go to the job creation, because I think it's really an important piece, and it's a longer conversation, obviously, but we did not start out looking at job creation. What we discovered, particularly again at the bottom of the pyramid in building out basic services, is that we have 60,000 people now working in our companies, because particularly when you get into these public contracts and you are reinventing, they create lots and lots and lots and lots of jobs. There are just two points for the impact space. One is, what is a job? So Kim, you talked about the farmers and the people working in the restaurants. Is increasing farmer income to the point where they become self-sufficient a job, or is it increased income? So one is the definition of job, and two, as we're exploring Acumen America, one of the areas that we're looking most at is workforce development, and some of the most interesting entrepreneurial plays, I think, are not only training up the entrepreneurs, but matching them to possible jobs. And so this seems to me an emerging but both undercapitalized sector, and we need a lot more entrepreneurs willing to go into that sector. So I would, again, make that plea for nuance a bit. Again, what is a job? And how do we both develop talent and match that talent to jobs that are actually crying for good people?
So we have just a little more than 10 minutes left, and this very patient gentleman in the back, please give us your question.
My name is Lance Price from the Antibiotic Resistance Action Center at George Washington University. And what I want to understand is, how do you define the scope of impact investment, right? So I know that rapid diagnostics could preserve the utility of antibiotics for generations to come. Does that count? You know, does Tesla count because it preserves
it's a great
energy?
Question. I'm happy to take that, but does anyone else want to jump in? Okay, so you heard me say at the beginning, because it's early days and we don't want to shut too much down, it really goes to a matching of the company and the investor. So if there's clear intention, if there's measurement, and if there's transparency around that, to me, that might be impact. To Kimbal, he might say, no, that's just healthcare investing. That's not impact to me. It really shouldn't matter as long as the conditions are there. What we think we'll see is an organization in the market to certify these companies. We already have B Corps. We may see some additional certifications and tax laws coming around benefiting them. But today, these are huge sectors: energy, healthcare, transportation, education, agriculture, that for the most part have been undisrupted and can bring tremendous social benefits. So it really is that making sure you have the intent of the investor and what the company's action is that comes together clearly and well understood. I'm sorry, right back here.
What an incredible diversity and depth of experience. Is fabulous. I hear a lot of talk about India. I'm just wondering if any of you have done anything in China, and if not, why not?
Panel?
So, well, we haven't invested there yet with our water credit initiative, but that is where we're going to be doing market research next year. I think it's just a little bit more complex there. I mean, getting debt into India is a challenge, and getting it back out is even more challenging, but we think we've got that figured out. But China is a whole different layer. And to come in to a sector, to a country where they actually refer to governmental NGOs there, which
Yeah.
kind of blew my mind the first time I heard that. But it lets you know how much you are through the look.
Did they get the NG stood for non-governmental?
Literally with a straight face. So it's not that it's not doable. We think it is, and we get lots of invitations to come in. In fact, I got an email last night from a philanthropist there that wants to bring us into China. But it is a much different environment. I don't know, Jacqueline, have you guys done anything in China?
We've not invested in China. We have young social entrepreneurs from China who are now part of our larger ecosystem, our fellows. There's certainly a lot of interest, and when you're working in solar, your manufacturing comes out of China, but not, and so we've sent our fellows there to work in companies like D-Light that are working with manufacturing, but no. It's still a complicated space for social enterprise.
So can I see hands in the back? I'm having trouble because of lights. Are there some hands in the back that I might have missed? Okay, we have some up front right over here. We have an early investment in an ed tech impact company called Cricket Media that's doing work in education in China, but that's been the extent of our China experience.
Jean-Pierre Huari with X1. I wanted to thank you all, and I think there's no reason you shouldn't be in the much larger ballroom because this is a fascinating
nice.
panel. I'm working, I think, to try and reduce food waste right here at home. There's a lot of it, and I think Jean, you with your work in Revolution, and Kimbal with your restaurants are familiar with the statistics as well as the rest of you. And I'm doing this by creating mobile technology to facilitate, let's say, a restaurant manager at Chipotle to notify Revolution that there's 10 pounds of chicken and beef left over at the end of the day they should pick up and reuse. And what you're talking about struck at me because I've been debating whether to be a for-profit or non-profit. And I think the combination, the hybrid approach you're mentioning is fantastic because it's not something you read about or see in the books or the Harvard Business Reviews. And it's really forward-thinking and ahead of the curve, and I just wanted to thank you for that. And I'd love to speak with you afterwards a little further.
Okay, great.
So on the non-profit versus for-profit, I want to say something. As an entrepreneur, you make a decision on what to do and you figure out what's the best vehicle. We're working in non-profit in schools because if you're a for-profit, you're not allowed to work on school grounds without heavy bureaucracy. And I was not willing to wait 5 years to get a business plan approved by the government. So we do a non-profit for that reason, but otherwise I do a for-profit.
So it is early days in impact investing, as we've made clear, but at the same time we have social enterprises like National Geographic, where I serve as a trustee. The parent organization is a nonprofit, but they've for a long time had a for-profit business that drives hundreds of millions of dollars in revenues each year that really fuels what they're able to do around the world. So we see some models that you might want to take a look at to be informed. Right over here, we can get the mic. She's coming, she's coming. Any comments while we're waiting for the mic? All right.
Yeah, my name is Mark Otimski. I am the chairman of a credit hedge fund in London. My question is, and I'm sorry to sound like a party pooper, but I really want to understand is if this is a bull market phenomenon or it's a really a long-term change in what people want to do. So have you seen things changing at university in America, or is it something that could disappear if we have another 2008, or if the stock market is not at the highest or liquidity is less than it is now?
I'm seeing it as a real movement. So, and I think it's not because of the bull market, or I do think the bull market is helping it. It's because of the next generation of the family offices. Yeah. So the patriarchs, matriarchs, they're all wonderful people, but they usually built their businesses with, very difficultly, and they know the difficulty of earning a dollar. And the millennials are coming along and seeing their parents or their grandparents with it and saying, yes, granddad, you're great, and we love you to death, but why are we investing in this business? If they bring them in, and which they do are more and more today, bring them in to making those decisions, those guys are really creating being the voice at the dinner table to care about impact as well. And it doesn't mean everything's going to change to impact, but it does mean that I think that it's going to entrench in a percentage of the portfolio towards impact for sure. There's no doubt in my mind. I mean, I've been seeing it now for 3 or 4 years moving.
Dimple, did you want to comment on that?
Yeah, that's exactly the approach our family has taken. Right now we have a very small pool of capital it's large for impact, but small relative to the family's assets, as a demonstration fund and pilot, testing these instruments, testing the boundaries of the returns and the structures. There is a hope for those of us that are on the team, of course, that it will be spread across asset classes. And there are a number of families and investors who have committed to pledging 100% of their assets. But even if they make that pledge, it can take up to a decade to get there. The Kleisners, who Jean mentioned earlier, they made this pledge a decade ago.
Yes.
And I would say they're about 95% there. So it starts with a pebble, and you hope there's ripple effects. But I think it is the way forward because of the millennials, because people are adopting a global consciousness. You have to be aware of what's happening around the world around you. We can no longer afford to be insular. And there's a cross-pollination effect happening where if you don't take care of not only your home country, your home city, but others around you, it's not going to make for a great world. So I think it's the beginning.
I think it's absolutely going to be around because you have people looking at alternatives now. It's no accident, I think, that individuals, high net worth individuals, family foundations are looking at this because they're smart on philanthropy. And they see the bifurcation here. Give the money away or let's impact, over the long term with an investment. Then following quickly behind that, you have foundations with their PRIs. And we see, of our fund that we've raised so far, 7 million in commitments, it's been predominantly individuals. And now it's moving over into foundations who have that mission and will be putting in PRIs.
I think that's right. So we have like 3 minutes left. So I'm going to ask the panel if we can go just right down the line and offer some closing thoughts. Tom, why don't we start with you?
Yeah, no, I think it's, for us, as mentioned before, returns matter. But I think it's really important to segment what you're after, right? I mean, Gary's working in a space, for instance, in India where you have hundreds and hundreds of millions of people without access to a toilet and trying to fill in deficiencies from very poor public policy. Now, in that case, is it really realistic to expect that he's going to put up, market rate IRRs? It's not. Right? I think for us, where we operate, and quite frankly, where many impact funds operate, is up to that $8 to $10 a day, where there still are significant deficiencies. Right? India is one of the least productive agricultural markets in the world. It has one of the least number of hospital beds per numbers in the population, and there is some paying power, and that's the segment we focus on. But you need to be very clear, and it's just not fair to paint everyone here with the same brush. I'm a huge believer that at the early stages here, you do need subsidized, impact-like capital at the bottom. Where we are very much focused on market rate returns because for us, when the companies get to that stage, we need capital markets to work for us given the size of the problems in India. So we're all doing very different things here. And I think a sense of realism about what we should expect out of the investments you make is warranted.
Great, thanks. Kimbal.
So I think that, and I'm going to talk on the behalf of the entrepreneur here, the key is you got to be able to attract great entrepreneurs. And so you've got to look at an entrepreneur coming out of Stanford and they can build the next Google, or they can work on a social enterprise. And if you cannot, as the investor, provide a mechanism that they have a similar upside. Now, the entrepreneur also will have a blended social and financial return because they'll be doing good, not just building dollars. But you have to be able to give the social entrepreneur an upside. You have to be able to attract them and get them excited about doing about taking social capital versus traditional venture or private equity capital. So I think most of you guys are investors. Trust me, what you need are great entrepreneurs. And when you get great entrepreneurs, you will get great returns.
Mm-hmm. Gary should go next to that.
Okay, Gary
is a social entrepreneur.
I think just looking at this in unexpected ways and to think that there would be a market among the 2.5 billion people living in poverty who lacked water and sanitation, that you could actually reach them through bankable deals. We've got to take the blinders off and look for those types of opportunities. And I think once we do that and help them become customers, there's going to be a lot of that 2.6 billion we can serve through the markets, because right now it's going to take about $200 billion a year over the next 5 years to get everybody water and sanitation. If we even had that kind of money, the total sum going in philanthropy, government assistance, multilaterals, the World Bank, everything else, $9 billion a year. We're not going to get there unless we can mobilize capital from the bottom up, and it's going to take a small leap of faith for this capital from the top down to help catalyze that.
Dimple, why don't you?
Yeah, I just want to, in the spirit of being open and collaboration that Jacqueline mentioned, I think continue to learn from one another, learn from us, those of us who've been at it for a while, those of us that are trying to push the boundaries. I think everybody's willing to share. We're going to be launching a website where we share our experiences in our portfolio construction and impact measurement, which we didn't even talk about today, thankfully, because I think that could be its own topic. So just experiment, push the boundaries, and continue to ask questions and learn, because I think everyone's here to collaborate.
Great, Jacqueline.
And then the reason I thought, Gary, you were going to go after Kimbal is that I actually disagree with you, Kimbal, in that I don't think the social entrepreneurs are only looking for huge financial returns, and that's the incentive. That
I'm saying that they're willing to have a blended return as well, but the investor also has to have a blended return.
Oh, I see what you're saying.
Yes.
I thought you were saying we have to really compensate.
The problem is the social entrepreneurs are going to investors that don't actually care about impact.
Right, because
and that kills them.
Right. Okay, so we agree.
Yeah.
It's good. Because
although it's kind of fun to have that.
I like his spirit. But I think that what we're talking about is the next chapter of capitalism. I think that what 2008 did was shake us all up to say, wait a minute, we're seeing this increasing inequality in our world that is so fundamental that the countries in which I work, Pakistan, India, Kenya, soon the United States, we are seeing what that looks like. And we need new systems. And the millennials understand this like no other generation. They have a fluidity in almost everything that they do. And it's time for us to get on that bandwagon. And what's so thrilling to me is that it's early days, as Jean said, but it isn't just a new class of investors that is coming on board, a new class of philanthropists. In some ways, the drivers that I'm seeing are the corporations that are recognizing, because of the people that they hire, that if they don't build sustainability into their overall supply chains and they don't change the way they're doing business, they're not going to have teams and they're not going to have customers. And so they become the best partners to really take this to scale. And so at the end of the day, this is a conversation within one sector, but in many ways I think it's metaphoric for a world that will require all of us to get more creative in how we build the systems that build a more inclusive economy. And that's really, I think, what we're talking about.
Great stuff, Jacqueline. I'll just say in closing, what are we talking about here? We're talking about something as simple as new ways to solve old problems, and you've heard a lot of examples of that given up here. You've been a great audience. Let me say, for those of you that are interested in the topic, you just want to learn more, this is a crowdsourced document we put together. You can find it on casefoundation.org. It's called A Short Guide to Impact Investing, and we try to draw out in that many of the themes that you've heard here this morning, and we encourage you to take a look at it and share it as well. We thank you for your participation this morning. You've been a great audience, and a word of special thanks to our great panel.